Well, hello. My name is Anthony Sicaro. I'm founder and president of Providence Financial and Insurance Services, located right in the heart of the San Fernando Valley in Woodland Hills, California. And for 5 years running, I was host of the Providence Financial Retirement Show, which aired every Saturday on AM 870 KRL Lay the Answer. And periodically, I like to give market updates and just keep you, my clients, informed of what's going on out there economically, along with how we have you invested. And that's the purpose of this video today. And if you're a client of mine, thank you for your business. Thank you for your trust. You know I don't take it lightly. If you're not a client of mine and you have any questions about anything you see or hear in this video, I'd be more than happy to talk with you. I would recommend you check us out at our website at providencefinancialinc.com. And certainly you can contact us through that website. And if you are a client of ours, I'm going to tell you that recently, within the last few months, we've redone our entire website. So if you haven't been there for a while, I'd love to have you go back and just check it out. Give us your feedback. Let us know your thoughts. It was Albert Einstein that said the important thing is to keep the important thing as the important thing. And the goal of this video is to remind you of what is the important thing with regards to economics and specifically your finances, the way that I have most of you invested. Now, in the last couple of videos, I've talked about the inverted yield curve. And I wanted to start by bringing you an update or giving you an update as far as where we are in the inverted yield curve. And more specifically, what does that mean going forward? But I'm going to tell you that the inverted yield curve is not the important thing. So you might be asking, well, what is the important thing? Well, the important thing is going to be discussed at the end of this video. What is the important thing? So you'll have to watch and then I'll tell you what the important thing is. But the yield curve is, in fact, gives us a good indication as to what's going on in the economy. And instead of me telling you why the yield curve inverts and what the yield curve is, I'm not going to do that again because I did a video about it back on March 25th when the yield curve first inverted. So that video was called What is a Flattening Yield Curve and What Does It Mean to You? That was done on March 25th, 2019. I've done one video, I think, since then to bring you up to date. I don't have the name of that video, but it's not going to be hard to find. These are both on my YouTube channel. I would go watch those two videos, and you will then know what is a flattening or what is an inverted yield curve. But the short of it is that it means that investors are willing to invest in 10-year Treasury bonds at a lower yield than for a 3-month Treasury bond. So the bottom line is that they're willing to commit their money for longer term than shorter term. And that's the opposite of what usually happens. Usually with a healthy yield curve, the farther out someone's going to commit their money, the farther out someone's going to lock up their money, the more interest that they demand. But that's not what's happening now. The 3-month Treasury bill is actually paying higher interest than the 10-year Treasury bill. Why is that? Go watch the videos and find out, and I explain why that is. But a yield curve gives us a good signal as to where the economy is going from here because it's been called by multiple sources a predictable recession indicator or a recession predictor. As a matter of fact, an inverted yield curve has preceded every recession since World War II. And there's only been one time that it's really given us a false alarm. So does it mean that there's always going to be a recession every time following an inverted yield curve? No, it doesn't mean that at all. But it is very reliable. And again, there's only been one time that the yield curve has not preceded or has given us a false alarm in the last 50 plus years, however long it's been since World War II. Now, I will say that the yield curve inverted last time, this immediate time, starting in March of 2019. But the previous time that the yield curve had inverted was in 2007. Matter of fact, right before the S&P 500 peaked in 2007, and of course in 2008 and 2009, the market gave back nearly 60% of what it had gained before. The time that it had peaked previously before that 2001, right before the 2001 crash, that the market gave back 40% or 45% in that range during that major recession as well. So it hasn't peaked in the last 12 years, or I should say that the yield curve hasn't inverted in the last 12 years, but it has now. And now it's been in and out of inversion, more in than out, meaning that it's been inverted more often than not over the last, well, since March 25th at this point. So there could be some problems. Now, keep in mind that the recession sometimes takes a couple months to follow. Sometimes it's been even as long as a couple of years to follow. So it doesn't mean that this is going to happen immediately. But I think it's just important to know that it's a predictor. It could happen, right? And yet the reality is that's not the most important thing. So what is the important thing? Well, the important thing for you, someone who is within 5 to 10 years of retirement or someone who is already retired, the important thing for you is to protect your principal and be able to live off the interest and dividends that your portfolio is going to give you so you don't have to sell shares. Some of you have heard me use the chicken and egg analogy, where the important thing is to protect the chicken, but leave the eggs alone. I mean, think about it. If you had a chicken coop that had to last you the rest of your life, do you want to eat the chickens or do you want to eat the eggs? Of course you want to eat the eggs because the eggs are a renewable resource, right? The chickens will continue giving you eggs. And yet, if you're invested in the stock market or you're invested in mutual funds, then in order to get the income, you have to sell shares to get the income. And if you sell shares long enough, if you eat those chickens long enough, then eventually you're not going to have any shares left. And if you live long enough, it's a great way to run out of money before you run out of life. So the important thing is to make sure that you invest in such a way so that you can live off of the eggs. You get enough interest and dividends to be able to live off of, so you don't have to worry about touching your principal. The important thing is leave your principal alone. Leave those chickens alone. Live off the eggs. And I want to show you a chart because several months ago I had this chart brought to my attention, and the moment I saw it, it had just a huge impact on me. And I've shown this chart to almost every person that's come in my office that maybe has a hard time grasping this concept. And the reason that people have a hard time grasping the concept is because the whole world of Wall Street out there is designed to get you to invest in stocks and mutual funds and growth-oriented items. There are very few advisors that actually talk about income. Growth in stocks and mutual funds are phenomenal for getting you to retirement. But very few advisors specialize as to what you should do when you get into retirement. How do your strategies change? And yet, I think from a logical perspective, if I told you that the strategies for getting you to retirement and putting money in are different from the strategies while you're in retirement and taking money out of your portfolio, I think that probably is common sense. That probably you don't have to know a lot about finances to realize that if you're putting money in, the strategies are probably different than taking money out. But the problem is this. The problem is Wall Street, the collaborative efforts of Wall Street through the media and so on, is primarily to sell stocks and mutual funds, and those are great for putting money in. So everything you hear about is all of these accumulation type vehicles, putting money in, because they don't talk about taking money out of your portfolio. It's a story that's untold. And I feel like it's my job to help tell the story to at least my clients. But the strategies are different. And the goal when you take money out shouldn't be to try to grow your wealth. It should be to protect your wealth, and it should be to make sure you live off the interest and dividends, because that's a renewable resource. If your portfolio is getting you interest and dividends that you can spend, then you know that next year they're still going to be there if you're not having to sell shares. So I think it's important. But what I did is this chart that you're going to see here came across my desk recently. And it was an eye-opener to me, and I've shown it to I don't know how many dozens or hundreds of people in the last few months since I've gotten it, and it's been an extreme eye-opener to them. So I want to share it with you, and let me preface what you're going to look at here before we actually put it up, so that you know what you're looking at. What you're looking at is you're looking at an example of someone who had $1 million in the year 2000. Why 2000? Because that was where the peak of the market was before we had the crash that ultimately went down in 2001 and 2002, where the market lost about 45% or so of its volume. So we look at the from 2000 to 2018. So it starts in 2000, and it assumes that you have $1 million in 2000, and that you were invested in just an S&P 500 investment. Could be an index fund, could be a mutual fund, but that you were invested directly in the S&P 500. That's what this chart assumes. Now, of course, if you're invested in the S&P 500, then you have to sell shares to get your income. So this chart shows what would happen if you were simply to sell shares and get $40,000 a year. That's 4%. A lot of you have heard of the rule of 4%. It's an age-old rule that basically says that if you have a combination of investments, including stocks and bonds, you could take about 4% a year out of your portfolio. And you can do that by selling shares and not really have to worry about running out of money. That rule has been questioned. I'm going to say that the rule has been debunked. It's really not true. But this chart shows, or kind of proves in my mind, that it's not true, that you have the concern of running out of money. So the first thing you're going to look at is a chart, and we're going to put them side by side so you can compare. And the good thing is you'll be able to stop this video and look at the charts, on your own time and take us whatever time you need. But the reality is that the first chart shows what happens if you had $1 million and you were taking out $40,000 a year, but you were invested in stocks or mutual funds that mirrored the S&P 500, and you were therefore having to sell shares to get your income. What happened to your $1 million between 2000 and 2018? That's what the first chart shows. The second chart shows what happens if, in fact, you simply took your $1 million and you put it into an investment that paid you 4% interest every year, period, without having to sell a single share. That's what the second chart shows. So look at the first chart now, and I'm going to walk through it with you. I've got it in front of me here. So let me walk through it with you. What you're going to notice on that first chart, again, is that you've got $1 million. You're taking out $40,000 a year. And the conclusion is that your $1 million over 18-year time period, the actual performance of the S&P 500, keep in mind this doesn't include fees, the actual S&P 500, you would have turned your $1 million into $315,000 over 18 years, meaning that you've lost almost 70% of your portfolio simply by selling shares. 70% of your portfolio, and this is not an 18-year period that is other than normal. It's not an abnormal 18-year period. This is pretty atypical. You look there, you've got some high down years, you've got some high up years, but if you count how many down years there are, 1, 2, 3, 4, what is there? 5 down years in an 18-year period of time. Some of those are double digit, but there's a lot of double digit up years. But the bottom line is there was one thing that caused this $1 million to lose 70% of the value, and that is selling shares. Eating the chickens caused this portfolio to lose 70% of its value. So I think that's very critical. Now, what's the alternative? Well, the alternative is investing in something that gives you enough eggs to be able to live off, enough interest or dividends. And here, this shows what happens if you just put your money in a CD that earned 4%. And by the way, I'll tell you that in 2000, you could have gotten a 20-year CD that was going to pay 5 or 6%. But what about if you just got a CD that paid 4%? That $1 million CD is going to give you $40,000 a year. And you can live off that $40,000 a year. And you can live off those eggs without touching the chickens, right? You leave the chickens alone while living off of the eggs. So the reality is, if you live off the interest and dividends of $40,000 a year without touching your principal, then 18 years later, you still have $1 million. Hallelujah. The reality is that the important thing is to protect your principal. The important thing is to earn enough interest and dividends to be able to live off of. I've not been a fan of the stock market for the last 4 or 5 years. I really, if you watch some of my videos, you'll know that that I've thought 4 and 5 years ago that the market probably has some major problems ahead. I still think that. I think there's been a lot of artificial manipulation of the market that has kept us from having a crash at this point. You can watch some of my other videos on that. But the reality is that's not the important thing. What the stock market does is not the important thing. I don't care what the stock market does. If you are in the stage of life where you're retired or within a decade of retirement and you need to soon start taking money out of your portfolio, then I want you to take it out of interest and dividends. I want you to protect the chickens. The stock market will not allow you to do that. And this chart is really kind of the icing on the cake that just kind of proves that it's better. You'd be in a better position 20 years from now if you lived off the interest and dividends without selling shares. And yes, I might be an attorney. And yes, law school taught me how to take a lot of simple stuff and make it really complicated. But I'm a simple guy. And the question comes down to this. If you're in retirement, do you want to sell shares of your portfolio to get your income? Or do you want to not sell shares of your portfolio to get the income? Obviously, the latter is the obvious answer. Let's protect your principal. That is the important thing. And as Einstein said, the important thing is to keep the important thing the important thing. And the important thing is to protect your principal, make sure you get enough interest and dividends, enough eggs to live off of while protecting your shares. Meanwhile, it's good to have an idea what the market's going to do, but I don't care for you what the market's going to do because you are not in the market with any money that you need income off of. And I think that's important. Now, a lot of you want as much income as you can get. So we have you fully in the market. We have you fully in income producing investments so you can get as much income as you need. Others of you, you don't need a lot of income. So what we've done is we've set you up in a position where you've got an income portion of your portfolio that is giving you the interest and dividends you need. But with the other portion of your portfolio, you can afford to gamble with it. You can afford to ride out the market, and you don't mind taking the risk. So if that's your situation, I don't mind to put that money in the market. But the reality is, I think now with some of the things we talked about, the inverted yield curve, and the fact that it's been inverted now for going on 4 months, I don't know that it's a good time. But it's your money. If you call me and say, Anthony, I don't need this money for the next 10 years, I think that's the minimum amount of time we're talking about, and you want us to help you invest in the market, we can do that as well too. And a lot of you have already done that. So wanted to give you a quick update. Remember to keep the important thing the important thing. Please protect your principal. Thank you for trusting us and allowing us to help you do that and to help you earn enough interest and dividends to be able to live off of. If you have any questions about this, please don't hesitate to call me. And again, if you haven't checked out our new website, we updated it, Providence Financial Inc. Same domain name, but new website. Feel free to check that out. Thank you and God bless.